Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial future with our money, our investments, our retirement accounts. He is Chris Mcintire, president and founder of Mcintire Retirement Services. Chris, glad you're here to provide this clarity because it is a pretty complicated financial world and a lot of nervous chatter out there. I'm hearing a lot of people really worried about the state of and stability of the economy and the market.
Yeah, it's certainly been one of those years to start 22 off for sure, and kind of an unfun quarter here. I think we basically had about 4 negative months in a row almost. Some of this started even before the Christmas holiday. A lot of this volatility, we did not get much of a sell-off or a correction back in 2021. So we started with one of those here in 2022, and then Ukraine got invaded by Russia. We've got the Federal Reserve raising interest rates, putting downward pressure on bonds. Commodities are up. So there are, the larger part of the overall marketplace between stocks and bonds have certainly suffered this year pretty greatly, in that range of negative 10% on bonds and negative 10% on stocks. And again, not all of them are treated equally, but in a general consensus, the area of the economy that's doing well would be the commercial real estate side of things. We've been using that as kind of an alternative versus stocks, bonds. Commercial real estate's done well, some good funds that are out there. And then also some positions in commodities, looking at some healthcare and utility type funds, kind of in that defensive nature as well. But, they're starting to get expensive as well.
Chris, an interesting world that we live in, interesting times where you note that both stocks and bonds are down about the same amount. Traditionally, that has not been the accepted outcome when plans, when asset allocation, when diversification has been discussed and those kind of investment portfolios put together. The thought process is that those things do not work in tandem, that they are not so correlated. Does this present some kind of interesting wrinkles and difficulties for planners today?
Yeah, it certainly can, Peter. No question about it, because, we get feedback from clients, and clients may say, I want to be conservative. And why is my account down 5, 6, 7%? I thought I was being conservative. And, the bond market behaves differently than what the stock market does. And like you say, most people will own bonds to offset risk in stocks. Right now we have risk in stocks with volatility, supply chain issues, rising prices, the threat of a slowing down economy. And then on the bond side of things, we have a rising interest rate environment. So new bonds are being issued at higher interest rates, which pushes older bonds down in value because they're paying lower interest rates, for example. And, once they are done raising interest rates, those bond prices typically come back up as well. So, the difference between a bond and a stock, Peter, is a bond has a maturity. So if you hold it until it matures, you get your money back and you can buy a bond paying a higher interest rate. So for many people with mutual funds, and that are in more of that shorter term duration where bonds are maturing in just a couple of years versus 20 years, like U.S. government bonds, 20-year U.S. government bonds have really taken it on the hit this year, right? Shorter duration bonds have not, because they don't have that big, they don't have that duration risk. They're going to mature. When they mature, the bond manager will buy bonds at a higher interest rates, and you walk up that ladder. So most people listening to this radio show today don't care anything about how the market behaves. They want to see, they look at where their statement was last month and where it is this month. And sometimes it's not that simple, right? I mean, the economics of all of this, especially in the bond market, are more than what the value of your statement was last month to this month, though.
The account value, the bottom line, what most people are really concerned about. And if you'd like to have a professional kind of worry about everything going on behind the scenes and helping you to navigate these difficult markets and the volatility that we are seeing, if you'd like an assessment of your current portfolio to see if you're properly positioned to meet your goals, if you'd like a strategy session to really run a risk analysis and know how much risk you do have in your portfolio, if you're kind of uncomfortable with what you have seen as far as performance, as we have set out through the first quarter and now moving into the second quarter of 2022, pick up the phone, give Mcintire Retirement Services and Chris Mcintire a call, 800-868-1194. That's 800-868-1194, 800-868-1194 for that complimentary review, that forensic financial analysis, and that planning strategy session. 800-868-1194. Chris, you can perform a risk analysis. You can actually show somebody where they may have this potential double whammy in their portfolio, where they may have more risk than they are truly aware, and can help them identify where they may have underperforming assets that could easily be addressed.
Yes, absolutely. And, when we get into a market that's behaving like this is, where is the risk at? And for a lot of folks, they may still be focused on the growth side of the marketplace, where value may be the place to look at. And what we mean by value is, there are a lot of companies that have been hit pretty hard in this economy right now, at least their stock prices. And earnings are still doing quite well out there. As we're in the middle of earnings seasons here this week. Pepsi beat their earnings forecast. Many companies are still beating. Those are good economics. That's not signs of, hey, things are getting soft. The threat is growth stocks going to be where it is, or is it time to shift more toward value, where we're looking for quality companies at depressed prices and letting them, kind of have their day in the sun, if you will. It's been a growth market for, many years, 6-7 years right now. The Amazons, of the world that don't necessarily pay big dividends. Those are growth stocks. Value stocks could be, would have been the energy market, last year. And obviously with oil prices, a lot of those stocks are probably not considered value stocks at this point, but would have been a good example of shifting from growth into value there. Energy being that sector.
Many of us, Chris, have enjoyed the last really decade plus, 10 years, 12 years of growth in the markets. But even this slight wavering, and in the grand scheme of things, let's be honest, this start to the year really has been kind of a slight wavering. It's not been an extreme downturn in the market, but it's still making some investors uneasy. They don't love seeing losses of any type in their portfolio. What is a more conservative-minded investor to do? What if we don't want to suffer losses at this point in time? Are there reasonable alternatives other than burying money in the backyard or sticking it under the mattress, earning nothing?
Yeah, and it's a challenge, no question about it. For some of us, my wife and I, for example, we've got just some cash, extra money sitting in the bank right now. It's not making much interest, but if it was in the market, it would be could certainly be taking a hit, and it's extra cash. Obviously, we're still making our contributions into our 401ks or IRAs, and most of the people listening to the show certainly should. I've had clients ask me this week, hey, should I be just putting my 401k contribution into the stable value fund? And it's if their portfolio is where they want it, they should be buying. You're buying at lower prices. These are opportunities. And, a couple of clients this week, I've said that too. Elon Musk bought Twitter. Who'd have ever thought Twitter's going private? And some of those stock investors got rewarded very handsomely for that, right? $54 a share for Twitter. The technology sector is what's taken a pretty big hit. So the Facebooks, even Amazon and Apple this year, those tech companies really took the hit. And that's usually what happens when they start raising interest rates. It gets the tech sector first, typically, because can they continue that sustained growth? And, so there may be some value in some of those technology pieces. For the conservative minded folks, what we've been doing for our clients is shortening those bond duration risk. So, trying to mitigate that interest rate risk. So bonds that will be maturing in a shorter amount of time to get rid of that interest rate risk and trying to maintain, we've had some luck with some commercial real estate pieces, and, there you've got to watch the liquidity side of things too, right? When you're investing in a real estate fund that owns real estate, to get your money back, they've got to sell real estate. So they typically don't want to do that. So they'll build a reserve of cash. So, but that's been a very strong performing asset class. Apartment buildings, manufacturing centers, specialty type buildings have done very well here in the last, I'll call it 12 to 18 months anyway, because you have people that pay rent. And if houses get too expensive like they are right now, people will have to stay in their apartments, and then landlords and whatnot can raise the rent to offset inflation. So that's what can make real estate an attractive asset class.
The way that most of us are investing, though, Chris, like inside of a 401k, we may not have the specific ability to kind of manage in the way that I think you're discussing and detailing, where we don't have the options to go growth or value or specific sector. Maybe we do, but they're very generalized funds. Is there something that the worker, the saver can do that is contributing to a 401k, and that is kind of the main portion of our investment progress? Or do we just need to understand that if we are investing as such, that market downturns are simply part of the investment experience and to be expected? Do we have to relegate ourselves to that reality?
I suppose to some sort of degree, you're going to have to, especially the younger workers out there that are, don't have the ability to pull funds out of their 401k and create an IRA of their own, where they have a wide variety of investment choices than the typical 6 or 7 or 8 mutual funds that might be in the traditional 401k.
Is that why it's so often suggested that when we leave a company and have a 401k, that we take our money with us and convert it to an IRA instead?
Yeah, you have a much wider array of investment options, from, stocks, bonds, mutual funds, real estate pieces, but just, anything under the sun, basically. And, your traditional 401k or 403b is going to have probably 7 to 12 different mutual funds. And many of them are those retirement lifestyle funds that have become so common that as you get older are buying more and more bonds. So, those are obviously taking a hit too. So if you're over the age of 59 and a half, or if you have an old 401k from a former employer, then you could look at, looking into an IRA where you have a lot more investment options. You could, in our world, we can use S&P 500 low volatility stocks, a number of different exchange traded funds that, maybe a little bit more suitable toward, your individual risk tolerances and goals and objectives as well, to better define what those investment options can be for the investor.
I think that's another great subtopic in this conversation about market volatility, is that many people utilize 401ks because it's sort of automatic. They know that it's happening, but it's out of sight, out of mind. And then inside the 401k, choose options, or maybe they only have the options for another wrapper of kind of hands-off, done for you automatically investment strategy inside of those target date and life cycle funds, which on the surface level, again, seems like a good thing because it's getting done, it's automatic, and the investments are sort of pre-formulated for us. But Chris, as I understand it, those kind of target date funds don't necessarily adjust for conditions. And in a market where both stocks and bonds are experiencing volatility, as we are seeing and have discussed, that may be a strategy that needs to be revisited, would you say?
Yeah, and they always come into attention when things like this happen in the marketplace, because the Fidelity 2025 retirement fund may have an entirely different makeup than the Vanguard 2025 retirement fund. So we'll probably see some of these things come out here, and, some of the investment options that are available in some of these, because, it's an easy thing to do, set it and forget it. I get that, and that might be okay for somebody that's 25, 35, 40 years old with still a very long time horizon. But, for somebody that's 62 getting ready to retire right now, and the traditional 401k investment selection, might not be, the optimum way to go about doing this. And, looking at some shorter bond durations and different types of lower volatility type of equity investing, or looking for dividends and things like that aren't necessarily available, right? Because the more funds and whatnot that a 401k is providing for its employers, the more that's going to cost, right? They got to pay to have access to all those pieces. So I think that's one of the reasons you're seeing less and less of those options available. And, I will say this, is remember what your overall risk tolerance is. If you're a moderate risk taker, so to speak, then, hey, a 15% correction in the marketplace is probably okay for a moderate type investor. And those things are going to happen in an economic cycle. I mean, we're now coming off of an economy that's been heavily influenced by the federal government dumping money into the system. And, now we're on the other side of that, where, okay, did they do too much? And did the Federal Reserve not raise interest rates fast enough and let inflation get out of the bag? And they probably could have set interest rates a heck of a lot higher, but man, you keep dumping money in the system and handing people checks and paying them money to not work. This is what you get with some of that.
Well, it's been said that history does not repeat, but it often rhymes. And we've seen this before, Chris. I mean, we could go as recent as 2018 was really the last time they tried to raise interest rates. And that year ended down about 18% in the market. They only raised the interest rates about a quarter of a point. 0.25%. And we saw that result, and they quickly kind of reversed course. But right now, the Fed's talking about aggressively raising interest rates. If we want kind of a historic perspective on that, the last time we really saw that was kind of the late 70s, early 1980s, similar kind of inflationary environment. And the market did not necessarily fare well during that period either.
Yeah, you're exactly right. That long period of inflation in the 60s into the basically 1980 was a tough way to go for sure. Inflation was very high back in double digits back then. 2018, you're right. They raised interest rates 4 times, a quarter of a point each time, and bonds were negative, stocks were negative, commodities were mainly negative that year. I think in 2018, Peter, we had more negative asset classes than any other time in history. And here we are in 2022. We've had 1 quarter point rate adjustment. Looks like we're going to get a half a point adjustment and maybe another half in the following meetings here to try to taper inflation down. So, it's going to be that type of year, and sometimes you have to hang in there. Ducking into cash and pulling all the way out of the market means you got to figure out when do you enter back into the market. And it's one thing if you're doing that with $10,000 or $15,000. It's another thing if you're doing it with $400,000 and $500,000. And I've had a couple of clients that decided to pull out, and they're just going to sit on the side and wait this thing out and see what happens down the road. We got Ukraine and Russia, that conflict going on, and who knows what's going to happen. So, but you turn the clock back in history. We've had a couple of world wars. We've had Korea, Vietnam. How long did we fight in Iraq, Kuwait, Afghanistan? So, we've had conflict throughout history, and not everybody, just pulled out of the market just because of that.
Well, what do we do with our money in the meantime? And then to your point there, like, how long does it sit on the sidelines, and how do we know when to get back in, Chris? While I can see some short-term comfort from sitting money on the sidelines, long-term, I see almost just as much angst on the other side of knowing whether or not that's the right thing to do.
Sure. And that's why you have to build around your overall risk tolerance and, have a safe money strategy like we've advocated here. We use them all the time for clients. all day long. And, Peter and I both, and, are strong advocates of that. And just in case the portfolio that's directly invested in stocks and bonds is down in value and you still want to take a vacation, that you have an alternative to do so. So, looking at some of those alternatives, the real estate piece, the annuity space you could go into and make a withdrawal. Doesn't mean you have to start a lifetime income or anything, but you got some safe money and you can, make a withdrawal on it if you want to. And kind of specifically referring to a fixed annuity or fixed index annuity. We're not in the variable annuity space in our practice, as Peter knows, but maybe the listeners do not. We're probably not our forte on the variable annuity side of things. Fees, expenses, and things like that kind of a knock against that part of part of the space.
Once again, we're talking about alternatives to risk. Variable annuities specifically do not meet that criteria. They do have the full risk of the market with the sub investments that they hold, whereas there are alternatives for safer money, Chris, whether you want to have a fixed rate for a set amount of years and then walk away with a fixed or a multi-year guaranteed annuity, or if you'd like to share in the gains of the market and have growth that way, but without the risk of the market, like a fixed indexed annuity, or if you'd like to set up a stream of lifetime income at some point in time in the future. There are places where you can get what I would consider more reasonable growth within that space, but still not have to take the risk of the market.
Yes, absolutely. So, there are alternatives to the traditional stock bond mixture, and, you're not going to find these in your 401k space. So again, for those of you that have some of those rollover options at 59.5, which is a triggering event, or 401ks from previous employers, that maybe it's time to have that conversation and see what may fit your overall retirement goals.
Once again, we are talking with Chris Mcintire, president and founder of Mcintire Retirement Services, Northwestern Ohio. If you've got concerns about your money, your investments, your retirement accounts, pick up the phone and give Chris a call. He can help you run that analysis, analyze your true risk exposure, help to identify underperforming assets, and look at solutions, options, and alternatives that can provide you with the tools to help you achieve your goals, whether it's safety and protection of principal, the opportunity for growth if you are risk adverse, if you don't like what you see going on in the market and the economy and are at all nervous about it, or if you'd like to take advantage of the opportunity to have further growth in the market. Based on your individual goals, your individual situation, Chris can conduct that strategy session with you and then put the plan together, construct the blueprint for your financial progress into the future and the tools that you should be utilizing. Pick up the phone, give a call to Mcintire Retirement Services, 800-868-1194. That's 800-868-1194, 800-868-1194. But Chris, kind of a renewed reality here. We've seen the past decade, 12 years be relatively volatility free. It's been a good time to be an investor. The market has gone way up in a short period of time without too many hiccups along the way. That's not normal. The normal state of the market does include some volatility, and it's like we've almost forgotten about that a little bit. But I guess being reminded here also during the COVID downturn, the most recent volatility that we did have, the market snapped back very quickly. That also was not necessarily normal. The normal state is a more prolongated kind of slow bleed into a bear market. Bear markets often happen over the course of a year or more from the peak to the bottom.
Yeah, you're exactly right there, Peter. And, I think historically, if you were to look at what's the normal downside that the S&P 5 has in any given year, it's like 14%. 2021, for example, we did not have that. We had so much, Fed-induced stimulus being added. The market just ran up. Obviously, in 2020, we had the coronavirus shutdown. Markets came down quickly. The government came in and with massive amounts of money to help kind of bounce it back up to record levels even. And then here we are in 2022 on the other side of probably too much stimulus. too much money. Some supply chain issues still left over from COVID, Ukraine conflict, and now, the Federal Reserve having to go into its arsenal to tame inflation down, which is to curtail monetary policy and make lending a little tighter than what it had been so that people aren't as apt to raise prices, right? Because, hey, if you own a business and you can raise prices 10% and still sell that many goods, guess what you're going to do? Raise prices 10%. That's a capitalistic society. So, if there's more goods available and more competition, that's where you get the price checks that come into play there, right? I can buy it cheaper at my competitor, but if your competitor keeps raising the rates, you can raise yours 9% if he raises his 10 and still make 9% more.
Well, which is why I sort of always balked at the term transitory that was being thrown around, over the past year when in reference to inflation, because if people are still buying at these higher prices, where is there any incentive for inflation or these higher prices to come back down? I just don't see it, Chris. And therefore, I think that coupled along with the amount of dollars that they created and put into circulation, really perhaps just beginning to see the tip of the iceberg on inflation and the Fed's weapon against it, raising interest rates. How effective is that truly going to be is kind of yet to be seen, but it certainly is going to provide some headwinds and some ripples for the market and for the economy, and therefore for our life savings and investments.
Sure. Take a look at the Florida real estate market, for example. It's on fire. Prices might be up 35-40% over where they were last year on a house. So that means a $500,000 house, if it's up 40%, costs $700,000 a year later. You are pricing so many people out of the housing market that they're forced to rent and again, drive up rental prices as well. And, we know what happens when house prices continue to go up and up and up. So, there's it needs to be a reversion to the means, if you will. And that's going to happen by the Federal Reserve or, just the economy naturally slowing because, must be a lot of money out there, because if a house was listed for sale last year for $500,000, I'm not paying $700 for it this year. It's the same house. It just costs $200,000 more. So that's the supply and demand issue. There's not nearly the supply of homes for the demand that is out there right now.
And that's why there are those out there that are paying those prices, as wildly outlandish as they seem to be to some of us. There's bidding wars, even at those higher inflated prices that are going on. It's an interesting financial world out there, Chris. There are opportunities. There are places to take advantage. There are places where we are benefiting and feeling the benefit. If we are a homeowner, we are appreciating the real estate market right now. But at the same time, Chris, if we sell our home to realize the benefit, we just have to turn around and go buy or rent, and those prices are inflated as well. So again, two sides to the coin there. And we've got to work through where we have the ideal and the goal for growth, but also may not want to experience downturns and volatility. And that's why, ladies and gentlemen, you really need to review and evaluate and understand all of your options. Chris Mcintire can help you through that. Pick up the phone, give a call, get that plan put together, have that retirement planning review and strategy session. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, many investors feel like they can overcome difficult economies and bear markets because they have done it before. We've lived through a few of these before. We've seen it. We've been there. We've done that, and we survived. Why is that different as time progresses? Why is a downturn in our 30s or 40s or 50s very different than a downturn that we may experience in our 60s or 70s?
Well, you're in the accumulation phase of money for one thing, and you're still putting money into the market if you're working in your mid 30s and 40s. And so it's great buying opportunities. If you're in your 60s and you're not contributing, you're actually taking money out of it. Those downturns can seem even a little bit more painful because you're pulling money out of investments that are going down in value. And that really takes a lot of the fun out of it, no doubt. Again, that's why you have other strategies in place, not just regular old investments that go up and down every day. And, Yeah, and you're glued to watching the TV all day to see what's happening from 1 minute to the next. You have other alternatives to help hedge some of those market risk and bond risk that we're seeing in the bond market right now. Interest rate risk. I'm sorry.
Well, the market has been a fantastic tool, and it has certainly gone up over time, but it has not always been smooth sailing. There are times where we face headwinds and rough seas, and we are seeing a little bit of that right now. Again, historically and put into the grand scheme of perspective, we're not that far off all-time highs, but the volatility is making many investors nervous, and that may be an indication that your plan is not properly aligned, that you are taking more than appropriate risk with your investments. And unfortunately, opening up your statement, it doesn't say that in red, bold print right at the top. You've got to do a little digging, and the help and assistance of a qualified, experienced professional with a trained eye can shed a whole lot of light on that and help you understand and uncover options that you may not be aware that you had. So pick up the phone, give Chris Mcintire a call. He does these kind of reviews and analysis, risk assessments with his clients each and every day, and with savers and investors like you choosing to be proactive and control your financial destiny and outcome rather than leave that up to the market. Pick up the phone, give a call for that complimentary review and retirement planning strategy session. 800-868-1194 to reach Mcintire Retirement Services and Chris Mcintire. Again, that's 800-868-1194, 800-868-1194. Chris, great show today, talking about these current topics and concerns of market volatility, the risk that we are taking. Always an important topic, and always a great conversation every time we get the opportunity to visit with you. Thank you very much.
Yeah, my pleasure, Peter. Sometimes the market oversells and then it corrects itself. And that's what investors have to hang on for the ride sometimes.
We appreciate your perspective and then the proactive planning that you do to help savers and investors across Northwestern Ohio ensure that they are working and that their dollars are working effectively to help achieve and accomplish those financial and retirement goals. Chris Mcintire, once again, your resource, ladies and gentlemen. Pick up the phone, give him a call, 800-868-1194. He's looking forward to speaking with you soon, helping any way he can.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.